Since we have to keep the agenda and the program, let me start the event. I'd like to thank everybody for being with us today. I think we have a terrific agenda. It's a great event. And we are kicking off the event with a great presentation on the markets. It's exactly what it says, setting the stage. So Martin, please come and take over.
Let me at least give you a card for the disruption. Hi, I'm Philip.
You have a clock in front of you.
I'll bring you a coffee at some point. We'll have a coffee.
You have to put it in 20 minutes.
You were here first, it's just that.
Ah, mais tu es français, c'est pour ça.
C'est pour ça.
Perfect.
Dear everyone, thank you to Nicholas and Capital Link for hosting and organizing such a great event. I'm looking forward to hearing many interesting opinions, thoughts around a very complex global economy and shipping market. Thank you very much. I think, in these times also with all the environmental regulations, which I think is really high on the agenda today, the shipping community should also be very proud as they are leading the way. I think that was not the case a decade ago. So in the last decade, shipping has come to a very good point where actually other industries are looking towards shipping. And setting the stage and trying to predict shipping market outlook in these times is not easy. After COVID hit in 2020, there have been several major topics impacting shipping, such as the oil price crash 3 years ago, happening at the same time as the pandemic. Then we've had unpredictable developments from OPEC. We haven't seen or had any transparency in production levels. And as of the last 12 months, we've seen the devastating conflict in Ukraine, monetary measures to battle the ever-increasing inflation. So we're now seeing a global economy under pressure. We've seen soft recession in various regions. And this is in the midst where shipping is trying to implementing unproved regulations to battle emissions. Thank you very much. So just a few words about ViaMar. A few words about ViaMar. We're a wholly owned company by VesselsValue, whom I assume most of you know. ViaMar is a small setup. We're an analyst house, 8-man strong analyst house based out from Oslo in Norway. And we focus on tankers, bulkers, containers, and LPG and petchem. Those are the 4 main segments that we follow, and together with VesselsValue we do 4-year forecasting on these segments, trying to make a market outlook and see where we are in the cycle. So a very traditional shipping market research company. And together with VesselsValue, as I said, they have been implementing CII and EEXI database. So together with them, I've tried to tie that into the presentation, and so it will be a market outlook, and hopefully with the commercial and the operational impact of the CII and EEXI, it will tie well into the next panel coming after me that will discuss CII complexities more in detail. So the brief agenda today, it's quite simple. It's a shipping markets outlook on the 4 major segments that ViaMar covers. And then I will look at the energy efficiency, both in terms of the implications and the opportunities that bring to shipping in general. And then also looking at the operational and commercial impact in terms of slow speeding, energy saving devices, demolition, how that also will impact the markets. So beginning with the shipping markets outlook, we always look at the big picture first. We look at the macro drivers, and that is especially focused around the oil price and the GDP growth. So beginning with the oil price, We clearly see it bottom out in 2020 after the oil price crash, after the lack of demand during the pandemic. And since then, it's been a pretty steep ride, peaking at $120 per barrel in 2022. And then although it has softened in the past couple of months, we have seen pretty high oil prices, and I think the latest is $85 per barrel as of today. And we forecast a high oil price going forward. We think we will be in the range where we are today, going up to $100 per barrel until 2025. And this is, you know, there are many variables coming into an oil price forecast, and I think the major variable is the underinvestments in fossil fuel production in the past years is not sufficiently covered by green energy investments. So that is the main topic, but also, of course, the impacts of Russian sanctions and oil flows is also really difficult to forecast how that will unfold. We're also seeing China easing the COVID restrictions. They've completed the Chinese New Year, so we're also optimistic. So from second half of 2023, we'll also probably see a quicker turnaround and a demand recovery happening also much sooner. Right. So looking at the GDP for the various regions, we're seeing, if you look at 2023, those should be the smallest bars for you sitting in the back, if you can't see it. But in 2023, we're seeing Europe and United States with basically zero growth on the GDP. So we are in a soft recession now. But if you would take, you know, that percentage in 2023, we're definitely seeing the lowest growth in the first half and a gradual recovery coming in the second half of 2023. For instance, China, you're seeing 4.4% forecasted for this year, and this is far from the target of 5.5, but we're seeing it's moving in the, say, right trajectory in terms of increased growth. And also, if you look at, you know, the PMI figures and looking at the latest figures available, you're seeing you know, both China and the Eurozone is at a 5 months high, so it's definitely going in the right direction, although most of the economies are just below 50. US pretty low at 47, but they're also at a 3 months high, so it's going in the right direction. So jumping into the market outlook, so for tankers, we're seeing, if you see on this chart, from 2021 to 2022, pretty low utilization. That came up in the second half of 2022. Very strong rates. Our forecast is a high utilization going forward for the tankers, tanker segments, and this is much to do with the low order book and also strong demand growth. And when we in ViaMar is talking about demand, we're talking, of course, in ton miles. So we're seeing that Russian crude is sourced going more to China and India, and we're seeing also the European, say, demand for oil is also going to be sourced from the Middle East and other places. So you're seeing a much bigger impact on the ton mile for the tanker market. So if we then jump to the rates, as you can see here, we're expecting a soft, say, first quarter of 2023. We have seen tanker rates coming up, but the main trajectory of the trend of tanker rates is positive. So that is basically much stronger ton mile demand effect, together with a very low order book that we have seen. Containers, that's a different story, as you can see from this chart. So the red line is the supply, and you can see that this is basically a supply-demand story, where supply is just outpacing the demand. I think also containers with 1.5 to 2 very good and strong years have been also helped by all these congestion factors that has vanished. We can't forecast whether that will come back. But if we look at the rate development, we're clearly seeing how it's not coming down to the, say, depressed times 5-6 years ago. We're seeing that it's coming down to a certain floor, and then gradually from 24-25 we're seeing a slow increase in rates from the containers. This is using the 6,500 TEU as an example. Looking at the dry bulk, we're looking at solid fundamentals as well for that segment, also driven by China mostly for coal and iron ore. And if we see the Baltic, it's a very volatile segment, and we are on average expecting those rates to be acceptable, decent, far above capex on a capex, and say from a point of view, yes. Now looking at LPG, this is a challenging segment because the LPG has been since 2019 been, I would say, in a super cycle. Strong US production, and there's been so many inefficiencies with the Panama Canal, loading congestion, infrastructure and discharge congestion in especially India and China. So just taking 2020 as an example, we saw a negative volume growth for the VLGCs. Still, with 20 deliveries in 2020, the LPG or the VLGC vessels were making $50,000 per day, basically the double of their capex. So there's so many inefficiencies. So although we're getting 43 plus vessels in 2023, we're still seeing rates today at $60,000 per day. So we are neutral in terms of a supply demand, as we're seeing supply is coming up. But the VLGC story has been much more about the inefficiency and rise of inefficiency. So looking also at the Baltic from 2019 until today, it's been volatile, but on average it's been 60% higher compared to say the traditional VLGC market that we saw pre-US. So say from 2000 until 2013, then from 2014 until 2022, it's been a very strong market. Now, I think, so those are, the four markets: neutral on LPG, a bit bearish on containers, and we remain optimistic on tankers and dry bulk. Looking at how CII and EEXI will impact these segments, because I think from a fundamental supply-demand balance, you can give your view on how you think things will unfold and how the rates will be. But what is really interesting is to see how many vessels that fall into the C to E bands on the CII. And this is 2022 figures, where we've gathered all the data using VLGC for the LPGs, the 6,500 for the containers. We're using the VLCC and the Capesize as reference. Looking also from the EEXI, you can clearly see until 2013 and after 2013 that the EEDI, so the efficiency on the designs, have clearly helped looking at the EEXI reference line, as you can see there. And so it's definitely going to be, a multi-tier segment going forward that is both on trades but also on ships. So you will see a very strong multi-tier environment. So what are ship owners doing? Of course, you can do energy saving devices. Many are doing it already. Anti-fouling, you put on propeller caps. So there are many, say, mitigation variables that you can do, and combining the ESDs, I don't have the percentages, but of course you make your ship more efficient, and you can also do with alternative fuels, or on the main engine and on the shaft that you have a shaft generator is also energy saving. So you will have those ships that are newer, you will have those ships that are older, and in between you will have energy saving devices to meet that implications of CII and EEXI. So the voyage implications are I mean, if you're a small, tankers, chemical tankers, you have 18 grades, you have to do multiple discharges, or you're in a trade where you anchor a lot, or you have congestion variables just as the VLGC. Sometimes, I mean, if you know the equation for the CII, it would make more sense to slow steam instead of anchoring. So those are, of course, that would emit more emissions. So I don't think the equations yet are there for shipping, because it is really making or increasing the implications for ship owners. So you have both on the port side, and you also have on the multiple discharges, the multiple cargoes. So it's becoming these multiple or multi-tier trade. And the same, as I said, for the ships, multi-tier ships, you have different age, different speeds. The different fleets can go up to a certain threshold for the EXI, for the reference speed, and also for the CII. You don't know it more until 2024, when you have collected all the data from 2023. So it will be very interesting to see how that will unfold. But looking at the operational and the commercial impact, and I think this is where we get to the most interesting of this presentation, where you see there's a limited operational upside. I've just taken the VLGCs as an example, and here you can see the laden and ballast speed, and you see the reference speed, which is basically the average EEXI speed that is the attained. That's what you're allowed to go. If you go above, you don't meet the EEXI. So if you go back to 2015, looking at the top, the turquoise line, or the light blue line, back in 2015, you can see all the owners wanted to catch those high earnings, So what this will mean is that you will not be able to speed up in a high freight rate environment. And it's the same. I mean, together with my colleague working in tankers, we were looking at, okay, so what's the relationship between slow speeding and utilization? We found that to be a linear relationship, so basically a 0.1 knot speed reduction for the whole fleet would increase your utilization by 1 percentage point. So that's fine, it's linear. But how about we look at the relationship with utilization towards freight rates? And we found that to be much more exponential, meaning that if you're in a low freight environment, the delta of the earning differential will not be that substantial. But if you're in a high freight environment, looking at the right side, you can see the same 4% fleet utilization increase that would come from a 0.3 to 0.4 and not slow reduction in speed. You would get a much higher delta on your earnings. And that is really interesting, because indirectly you can say that slow steaming is exponentially affecting the rates. So where you want to be as a ship owner is definitely be with the ESDs, all the energy saving devices, or the mitigation factors, making your ship as efficient as possible, because you will have the competitive advantage to meet as high speed as possible in a high freight rate environment. And then you will counter all the older ships that will do engine power limitation or demolition, which will move the equilibrium for the whole fleet towards a higher utilization, towards a higher freight environment. And in order to then catch the most competitive advantage then, is by having the most efficient ship. So I think this is, one of the key slides from today for me, is the exponential relationship between utilization and the earnings. And also, if you look at just a theoretical impact on the TCE, looking from an index 100, if your service speed is 16.5 knots, from the left, you can see how going down to 13.5 knots is reducing your TCE potential by 10 to 15%. So it's quite substantial. Taking a VLGC as an example also here, looking at the age, but also looking at the fuel, you can see from a 2009 build running on VLSFO, and then you have a newer 2023 built VLGC running on LPG, you actually have a 30% difference in the TC. So these are theoretical figures, but it's showing how big deltas you're getting from these regulations that are going to be implemented, and it really depends on what ships you are having, what kind of devices you are trying to mitigate these factors with. So to conclude on the shipping, let me see. So on the shipping market outlook, we are positive to tankers and dry cargo. On the LPG, we're neutral. It could be very positive with, these inefficiencies continuing in the market. And on containers, for the next couple of years, we think that market will struggle due to the high supply of ship, 2% of demand growth expected, which is really, really low. But then again, the congestion variables that came a couple of years ago and made the boom in containers, you never know when or if that will come again. For the energy efficiency and the regulations, it's creating implications, but you have opportunities in terms of efficient ships, and you have implications, of course, if you're in trades that require multiple discharges. It requires more, say, shorter voyages. So it is a difficult time, and it's also difficult, deciding what kind of ship are you going to have. Is ammonia ready in 2024? Is it ready in 2027? Is ammonia the right fuel? Is it corrosive? So there's, all these questions that are just so difficult to answer. And then from the operational and commercial impact, we have seen that you have the exponential relationship between utilization and freight coming from slow steaming. That could be on parts of the fleet, right? So you could have 2013 built and before, will probably slow steam more. But it also depends on where you are in the cycle. If you are in a high freight cycle and you see some slow steaming because you have to do it, you will see a much higher delta on the TCE differential. And then it's all about having the most efficient ship. That's basically my conclusion. And then for the next panel, I'm really looking forward to hearing the CII and the complexities of that more in detail. So that's all from me. Thank you much for listening, and here's for a great day. Thank you very much.